Pete is. You know where Brother Pete is?
You're watching C-SPAN and our live coverage of the Senate Budget Committee. We're awaiting the commencement of this hearing on the fiscal 1989 federal budget. Members of the Budget Committee will hear from Alan Greenspan, the chairman of the Federal Reserve Board. Mr. Greenspan is in the hearing room, but Senator Lawton Chiles has not yet officially gavelled today's hearing to order. A reminder that later today, the U.S. House of Representatives meets at 2 p.m. Eastern Time, 11 a.m. Pacific, and as usual, we will bring you live gavel-to-gavel coverage. Today, the members will meet to consider the Civil Rights Restoration Act.
For the years, this is our first opportunity to welcome you as chairman of the Fed, and we certainly do welcome you on that basis. A little over 200 days ago, you became chairman of the Board of Governors, and it's been quite a time. You've had to ride the giant slalom of the stock market and the dollar, and at the same time, you've had to try to steer a winning course between inflation and recession. We know that it hasn't been easy, especially with the obstacle on the course as large as the federal deficit. But you've done a good job under tough conditions. Our trade picture has improved with a sharp upturn in exports, and we all hope it's the beginning of a trend. We need some time for stability to return to the currency and financial markets. Still, the conventional wisdom these days is that the next president and the next Congress is in for some agonizing time. The national debt has ballooned, and it's getting bigger all the time, along with interest payments. The federal deficit is substantial, and we continue to borrow money to pay the freight. I, for one, am more concerned than ever about the ongoing redistribution of wealth in this country. The rich seem to be absorbing more of the wealth produced by the great body of wage earners in the middle-income category. We're at a point where those who lend as well as those who borrow are overextended, and middle-income Americans are squeezed from foreign competition and by the demise of the good-paying manufacturing jobs. My guess is if there's one thing that would make your job easier, it's a sharp cut in the federal deficit. We know how hard it was to work out a two-year $76 billion package last year. The choices ahead are going to be even harder. We're certainly going to need your help this year to sustain the economic expansion. But it should be clear to all of us by now, without basic structural improvements in our borrowing habits, the Federal Reserve can't do it all forever. Times are very complex. We have the haunting feeling that conditions are still fragile. Some ways we're like that patient that's had that heart attack. He's in that convalescent period hoping that there's not going to be a reoccurrence after what we saw with the stock market. The one thing we can be sure of is that we're approaching a time of major choice in our affairs. We've got to find a way to make additional spending cuts at the same time we're making important investments in the future. We certainly welcome you, Dr. Greenspan, and your views today on what needs to be done in the months ahead to deal with our deficits both at home and abroad. We're glad you could be with us, and we certainly look forward to your testimony.
Mr. Chairman, thank you very much. Chairman Greenspan, I too welcome you, and I note that going back over the record, you have appeared before this committee more times and in more different capacities in your public career than any other individual in the history of the Budget Committee. So today we welcome you in yet a new capacity as Chairman of the Federal Reserve. And might I say, while I have reviewed your testimony. I have done so only in a cursory manner, and I hope that what I'm going to say about interest rates will be taken in the same light that I will take your admonition to us in your testimony as to what we ought to be doing. You have a very lengthy litany of what you assume we ought to do in areas of fiscal policy, and I hope you don't think I have changed my attitude regarding your independence, the independence of the Commission, and how important it is to stability in this country, because I truly believe that. I have read the book that allegedly talks about the secret army called the Federal Reserve that runs everything, but I haven't changed my mind. But since you can tell us what we ought to do, I would just like to share a concern I have about monetary policy right now, just for a minute. Your predecessor used some language before us. Incidentally, he didn't used to tell us what to do as much as you are in your statement. He just talked about inflation, mostly. But he called that the Northwest Passage that we had to get through, inflation and inflation expectation. And he kept telling us, Mr. Volcker, we got to get through that Northwest Passage of high inflation and inflation expectation. And we used to ask him what he looked at in terms of inflation expectations, and of course he would mention a few, but labor costs and increases in the major labor contracts were very important, and inflation was very important. And I really know that you're getting pushed on all sides. Don't be political this way, and I'm suggesting you not be political either way. But 1985 inflation, 3.2. 1986 inflation, 2.6. 1987 inflation, 3%. Labor cost increases, using the index that's most accepted by economists. 85, 3.1, 86, 2.5, 87, 2.8. Now, there are some who will say our reduction in inflation is accidental, unexpected, we did nothing to earn it, but it's real, it's there, and I don't see anyone predicting major increases in inflation. Well, I look then at what's happened to real interest rates. That is the percent of that interest rates in the marketplace exceed inflation, and I regret to tell you that I don't understand. In 1983 it was 7.2, in 1984 it was 8.7, in 85 it was 7.4, and now it starts to come down. In 86 it's 5.1, and then it starts to go up. In 87 it's 5.4, and if I read the current right, in 88 it's 5.5. Frankly, I don't understand, with those inflation rates, those labor costs, and in spite of poor performance up here, with a lot of hard work, we've reduced the deficit to 1.5% of GNP. That's not a little bit. It's a lot. Some would say it's temporary. Some would say, how are you going to fund defense at the levels you're at, and all these other things, but we've done it. 1.5% of GNP reduction. And I don't understand why real interest rates don't come down under those set of facts. I'm concerned, and I hope everyone understands that, yes, we have this big deficit, but it's the interest rates that we have to pay to debt service that deficit. I mean, my rough calculations are 1% adds $11 to $12 billion to the deficit, based on the current deficit that we have to fund. I mean, we struggle to find 11, 12, or 15, 20 billion dollars in cuts, reductions, and or revenues. And I repeat, 1% interest rates, interest rate reduction is $11.5 to $12 billion based on current levels of deficit. And so while I accept your admonition to us regarding the deficit and your analysis of what we ought to be doing in entitlements and in other areas, I am somewhat confused as to why interest rates aren't continuing on a downward path, and not with a great hoopla that it's reduced 0.25% because of the discount rates. And so I welcome you. I hope you will tell us today whether you have some new indexes you're looking at. We kind of got to know what the previous chairman and commission was doing, what they were looking at. I'm reading all kinds of new commodity relationships, and I'm very interested in how you're looking at real interest rates and your responsibilities there. Thank you, Mr. Chairman.
Thank you, sir. Dr. Greenspan.
Thank you very much, Mr. Chairman. I would like to excerpt from my prepared testimony and request that the
Your statement will be placed in the record.
Thank you.
Would you pull your mic up a little closer to you, please?
Mr. Chairman, members of the committee, I appreciate the opportunity to appear before this committee today as you begin your deliberations on the budget for fiscal year 1989. The summit agreement reached with the administration in November, if fully implemented, should maintain pressure on the deficit this year and next. But it is crucial that further actions in support of a long-term policy of reducing budget deficits and the associated claims on the nation's supply of savings be taken. As I reported to the banking committees last week, 1987 generally was a good year for the U.S. economy. As we move into 1988, members of the Federal Reserve Board and the Reserve Bank presidents look for a moderate rise in real GNP over the course of this year on the order of 2 to 2.5%. Inflation, meanwhile, is anticipated to fall within a range of 3.25% to 3.75%, similar to the 1987 pace. The central tendency of our projections for real GNP growth this year encompasses the administration forecast, but is somewhat stronger than that of the Congressional Budget Office. We also are a bit more optimistic on prospects for price inflation. However, the differences are not large. In this context, the Federal Open Market Committee at its meeting last month set ranges of 4 to 8% for growth of M2 and M3 this year. Looking beyond 1988, prospect for maintaining balanced growth as well as continued improvement in our external accounts will depend importantly on developments in the federal budget. In that regard, the importance of taking actions to make a sizable dent in the deficit during periods of satisfactory economic performance becomes even more apparent when we recognize the likely effects on revenues and outlays of a future economic slowdown if one were to occur. While we all seek to avoid recessions, the Congress cannot count on indefinitely sustaining federal revenues by a growing economy. The achievement of meaningful deficit reduction undoubtedly will require that some hard decisions are made. The adoption of Graham-Rudman-Hollings' approach and its reaffirmation last year highlight all too vividly the extraordinary difficulty of making such choices. There are no easy answers or magic formulas. Nonetheless, economic logic and historical experience can provide a framework for analyzing the range of possible options. I suspect that in the long run there are upside limits to the share of income that can be taxed. For several decades, the overall federal tax bite has been fairly flat at a bit less than 20% of GNP, and under current tax laws will remain in this range into the 1990s. This stability over time is not a coincidence, but is indicative of the public's aversion to rising tax burdens. That sentiment was reflected in the many small tax changes in the 1970s, as inflation pushed many taxpayers into higher brackets, and in the large reductions that were enacted in the early 1980s. Of course, no one likes higher taxes, but I also sense a more sophisticated awareness of the disincentives and economic inefficiencies that seem to grow disproportionately along with the size of the tax burden. And people are skeptical that tax increases will translate fully into smaller deficits given the reduced pressure to control spending that would result. This does not mean, however, that revenue changes should be dismissed out of hand. Some specific taxes may serve other desirable objectives while also bringing in needed revenues. For example, I have long urged the consideration of a sizable increase in the federal gasoline tax. A hike of 15 cents per gallon, for example, could raise close to $15 billion in revenues, while retail gasoline prices still would be well below the levels of the early 1980s. And if energy use is restrained at all, there is a further benefit. But on the whole, deficit reduction efforts must of necessity focus on the expenditure side of the budget. Over the past 3 decades, we have seen marked shifts in the composition of federal spending, accompanied by a distinct upward trend in its ratio to nominal GNP. That ratio, which reached 24% of GNP in the mid-1980s, has edged off in the past few years, in part because the administration and the Congress have been relatively successful in holding the line on new programs. I do not underestimate the difficulty of the task of further reducing the ratio of federal outlays to GNP. Several rounds of deficit reduction efforts already have taken care of the easy cuts. Partly as a result, the composition of the budget has shifted towards those categories that are less amenable to control, at least in the short run. In particular, interest payments were nearly $140 billion last year, and in light of prospective deficits are likely to grow even larger in coming years. The way to control these payments and to get a handle on the scale of federal debt relative to GNP is to concentrate on the remainder of federal spending and on the so-called primary deficit, that is, the deficit excluding interest payments, net of taxes on interest. Controlling the growth of outlays is crucial and will require close scrutiny of virtually all programs. Such control in the face of demographic pressures will demand a willingness to take bold, controversial actions. It is essential that this committee focus on those changes that will result in significant savings, not just this year or next, but on a lasting basis. It would be inappropriate for me to offer suggestions on specific program actions to reduce the deficit. All the alternatives are known. The choices are political, not economic. But simple arithmetic points clearly to those areas where the scope for action is greatest. For example, entitlement programs offer substantial opportunities for long-term budgetary savings, since they currently account for nearly half of total outlays. And with the base of expenditures certain to expand in conjunction with the increase in the beneficiary population during the next few decades, the deficit reduction benefits of changes in the law today will accumulate over time, leading to much larger savings in the year 1995 and beyond than in, say, 1990 or 1991. Leaving aside the serious questions of evaluating military adequacy, the budgetary arithmetic of cutting defense spending is considerably less favorable. In part, this is because the Budget Summit Agreement already has solidified a recent trend toward reductions in appropriations from President Reagan's original overall defense plan. But more fundamentally, defense programs are essentially lumpy. A large share of spending in the early and mid-1980s went to build up our military asset base. But as we reach the requisite number of F-16 wings, air carrier groups, missile deployments, and the like, expenditures will fall back toward maintenance levels, which are significantly lower in real terms than the huge outlays of the past few years. Accordingly, reductions in defense procurement programs are not translatable, as they are in entitlement programs, into very much larger cuts in the future. As for discretionary domestic spending, these programs are a small and shrinking share of the total, and many provide services that enjoy broad support. Moreover, in a number of areas such as law enforcement, environmental protection, and air traffic safety, there are few feasible alternatives to the federal programs. There are, however, areas where the private sector probably can provide services more efficiently and at lower cost than the government. The President's budget placed a high priority on privatization and suggested several activities that could be transferred out of the federal sector. I believe this emphasis is appropriate and deserves careful consideration on its own merits. But I would stress that the resulting asset sales should not obscure the more fundamental budgetary issue. Indeed, I would be troubled by the extensive use of asset sales as a long-run deficit reduction strategy. Merely shifting the ownership of an asset from the government to the private sector has little effect on overall credit demands. Moreover, it produces only a one-time budget savings. I would also be disturbed by the greater use of federal credit guarantees as a substitute for on-budget outlays. Such a substitution may lower the measured budget deficit, but it does not reduce the federal presence in credit markets. Both the administration and CBO have long argued that current budgetary procedures give a misleading impression of federal credit activity. In this regard, the administration's proposals for reform, which call for the explicit recognition and better measurement of the subsidy value of credit programs, point in the right direction. The smaller public sector would carry significant benefits in terms of improved efficiency of the overall economy. The relationship between the size of the government and economic performance is complex and depends, among other things, on the mix of consumption and investment in government spending. Moreover, budget figures do not capture the full scope of governmental activities on real resource allocation. The effects of government economic regulation on private activity may be sizable. International comparisons inevitably are difficult, and the empirical evidence is only roughly suggestive of broad trends. But the disappointing macroeconomic performance of many industrialized nations over the past few decades in the face of rapidly expanding public sectors does raise questions about the true costs and benefits of large government expenditures. Indeed, in several European countries with sizable public outlays on income maintenance, education, and health care, those programs are coming under increased scrutiny, in part because of a perception that some of them have had detrimental effects on individual incentives and resource allocation. To sum up, the benefit from taking credible actions to curb federal outlays and related credit demands will be enormous. Over the longer run, lower deficits will absorb less of our private savings and, all else equal, allow private investment to flourish. Moreover, a clear demonstration to the financial markets that the current services budget has been set permanently on a more favorable track will have a handsome payoff currently in terms of lower real interest rates. As I stated earlier, one way to achieve that outcome is to exploit the wedge effect arising from reductions in programs such as entitlements, where the savings tend to grow over time. I should note, too, that in my view, you run little risk of setting deficit reduction objectives that would be excessive in macroeconomic terms, given the broad constraints of political feasibility. And at some point in the future, it probably will be desirable to aim not just for smaller deficits, but for outright budgetary surpluses. In closing, let me commend the Congress for initiating the National Economic Commission. The commissioners face an extremely difficult challenge, and I wish them well. Thank you.
Senator Conrad.
Thank you, Mr. Chairman. Mr. Greenspan, some of us view the summit agreement that was reached last year as more a summit surrender on the deficit, with the deficit not going down but going up. Many of us believe very strongly that we need a credible plan for year-to-year deficit reduction, a reduction that would allow an easing of monetary policy so that we could get this economy moving again. I'd be interested in your view. Should the Congress stick with the summit agreement that was reached last year, or should we this year junk the plan and go for a more aggressive deficit reduction package?
Senator, having observed the difficulties of the budget summit last year and the extraordinary pressures which on many occasions I thought would essentially break the process apart, I thought that it came out in the end in a way which suggested to me a commitment on the part of the Congress and the administration to reduce the deficit over the long run, very much in line with the suggestions which I think you very appropriately make. I guess I, like everyone else, would like to see the deficit come down very quickly and hopefully get that particular problem behind us.
But this is your opportunity to weigh in and urge us to do more.
Well, I am and I do, Senator, but what I hope we don't endeavor to do is to fail to recognize the areas where actual success has been made, because it's not that many years ago when the long-term current services budget was being projected up at $300 billion. And the very sharp reduction that has occurred to date is a very major improvement, and I think one of the reasons why real interest rates have come down in part. Having said that, it would be a great tragedy to allow the progress, which has not been insubstantial in recent years, to be dissipated, and a program somewhat similar to what you suggest, namely to reduce it periodically, would be beneficial. However, I would not merely scrap the budget agreement of the agreement of last fall, largely because I think you have to put one back together again, and I think I would build from where we are as distinct from tearing apart what has already been produced.
Well, let me ask you this way. Did the proposal that we put in place last year reduce the deficit on a year-to-year basis, in your judgment?
Reduced it from what it otherwise would be, and I would...
Well, I'm not talking about that. I'm talking about from the levels that we had the previous year. Did the agreement that we put in place reduce the budget on a year-to-year basis from the level that it... Did the agreement that we put in place reduce the budget on a year-to-year basis from the level that it was?
I think the deficit will be up a shade in this fiscal year.
It will be up. The deficit will be increasing.
A shade, a small amount.
And are we to call that progress?
Well, it depends on the base where you start from. I think, for example, that no one, especially economists, would have projected a deficit of $150 billion for fiscal 1987, nor the size of the reduction that occurred. And I would suggest to you that perhaps the base we should be looking at is not fiscal year 1987, which has, as I recall, approximately $20 billion in it from the Tax Reform Act. I would look at the notion as coming off the $221 billion in fiscal 86 and projecting it down. I think that the way of measuring the appropriate impact of the budget on the economy and the progress on deficit reduction is not to look at the year-by-year fluctuations, which I think can be aberrations, but to look at the trend. And I think if we do it in that context, I think our focus should basically be on fiscal 90, 91, and into the future.
Well, if we look at, let's take a three-year trend, 87, 88, 89. You factor in the Social Security surpluses, if you leave those out, would you say that we've made any progress on the deficit?
If you take fiscal year 1987 as a base, then statistically, I think not. But I would be quite reluctant to accept 1987 with its abnormal reduction as a base from which rational processes of budget reduction, I think, can logically proceed.
Well, I must say I'm somewhat surprised at your answer, and disappointed, I might say, because I think if we were serious about doing something about the deficit, we'd do a whole lot more than was in that summit agreement, and it appears to me the actions of the Fed belie your answer.
Well, let me say this, Senator. I don't know of anybody who liked the summit agreement, including the participants, and that's basically the nature of an agreement. If you're asking me, would I like to see the deficit brought down much more sharply, the answer is yes, I would. Do I believe that
How
it
is
is...
that going to happen unless we tell this Congress and this administration that we ought to do that this year?
Well, I think that my notion of where this committee is headed, where the Congress is headed, and the implications of the budget summit is that the current levels, reduced as they are from their peak, are unacceptable, and that there is no tolerably acceptable budget deficit level. And in fact, as I stipulate at the end of my prepared remarks, I think that zero is not enough. I think we have to move further, largely because of the savings abnormalities that exist in our system.
Senator Minichi?
I'd be glad to let Senator Sims go.
Senator Sims?
Thank you very much, Mr. Chairman. And
Our lights aren't working, so I'll try to give you a little signal when your time is.
And thank you, Dr. Greenspan, for your very thoughtful statement. I wondered if I could ask if you would like to comment on your view of what the leading economic indicators meant that were released recently. I think it was yesterday. And if this means if we're going into, if in your interpretation we're going into somewhat of a slower economy or a recession, and if so, what will those implications be on the budget deficit in terms of revenues to the Federal Treasury?
Senator, I think the leading indicators in total and decomposed into their individual parts are fully consistent with all other evidence that we have about where the economy is and where it is going. We have slowed down somewhat in the first quarter to perhaps roughly half of the slightly abnormal pace of the fourth quarter. There is no evidence, however, that we are about to tilt over into a recession. It is certainly the case that we had somewhat abnormal inventory accumulation in the fourth quarter, but if that were about to trigger a recession, I think we would see it in a marked weakening in new orders being accepted at manufacturing establishments. And at the moment, precisely the reverse is the case. The orders are strong, and it is suggestive of a fairly solid, although not spectacular, continued growth throughout the rest of this year.
Another question I was interested in, and that is that there seems to be a, the specter of somehow that foreign investment into business and industry and assets in this country is some kind of a threat to the security of the American economy. If Congress were to, and states individually, start passing laws which preclude foreign investment, what would your impression of that impact be on our economy?
I think it would be very regrettable, Senator. Foreign investment is not a threat to this nation. When such investment moves to our shores, it becomes a company which is incorporated under U.S. law. It is required to abide by the laws of the land. It, in many instances, acts as an ideal corporate citizen. they create jobs. They do everything that domestic investment does. And I merely only need point to what I think was an extraordinary event in the 20th century, U.S. Direct investment in Europe and elsewhere in the world, where American companies developed the economies of a lot of nations that were devastated after World War II. And I think that the very process itself, whether it is we who are doing it or we who are the recipients of it, should be encouraged, not restricted.
I thank you very much for that answer. I was hoping that's what you'd say, and I quite agree with your viewpoint on that. I don't know how my time is, Mr. Chairman.
You've got time for another question.
Okay. On page 8 of your testimony, you mentioned about privatization and the high priority the budget has, and then the next paragraph you mentioned about the greater use of federal credit guarantees. But I was concerned that your comments about privatization didn't seem to be as enthusiastic. Am I misinterpreting that? Doesn't the privatization of loan portfolios and other things reveal what the subsidy is in them to us greatly? And in the long run, wouldn't privatizing government ownership of whether it be land or railroads or whatever increase the tax base, the efficiencies, and thereby enhance government revenues in the long term?
I'm in favor of that, Senator, not for budgetary reasons so much as it's a question of efficiency of economic performance, but you're quite correct that it does increase revenues, and I think that where we can, I think we should encourage it to a maximum.
Well, I guess I'm more sensitive to this than many of my colleagues on the committee, coming from a state that the federal government owns 2/3 of it. And when I hear people in different parts of the country complaining about their problems with government, I say you should move out in the West somewhere where the government is the landlord of the large sections of the state. When we elect a governor and he's only governor of 1/3 of the state, and the BLM and the Forest Service run the rest of it, I think maybe we're more sensitive to the complications in production and the complications of the utilization of the resource and even the recreational values, for that matter, because of massive government ownership. I believe they own about 1/3 of the land in the United States, and I think no telling what would happen to this economy if that land were held in private hands, but I don't anticipate that happening under the current viewpoint that's politically popular today, but maybe someday that might even change. Thank you very much. I enjoyed it.
Senator Holly.
Congratulations, Dr. Greenspan. I know, like Senator Conrad, I'm frustrated with the casual dancing around the fire of a particular problem. We who are trying to pay the bill up here need a Federal Reserve chairman to tell us exactly what's what. And when you finally agree and say you'd like to see the deficit brought down more sharply, let's testify to that and give us the very Dickens and tell the Congress, don't come up here and psychoanalyze and nibble around. The truth of the matter is that rather than reducing the deficit in the long run, that summit agreement didn't bring it down at all and guarantees that deficit to go up. Specifically, the summit agreement says let's spend 2% on domestic and defense. That's 8.5 and 8.6, 17 billion. It said, by gosh, let's give increases in entitlement. That's 36. And it said we've got to pay the increased interest cost, which is 15, so that's 68 billion in increased spending. And both the CBO and OMB and you all agree on revenues, and that's only 56. So we got a $12 billion shortfall. Didn't bring the deficit down, it increased the deficit. And then if it accomplishes the design, namely to bring it down to 136, the CBO just has estimated it to be 176, so you got to bring it down another 40 billion. So that's a 52 billion masking. That's why I call it the phantom of the budget. And you shouldn't be helping masking or continuing this phantom of the budget deficit. I will bet you categorically, and the Lord willing, you and I will both be back in January, that rather than 136, it'll be nearer 186. How much you want to bet? Let's lay it on the line. It doesn't reduce it a bit. I'll bet you and give you the odds. It'll be nearer 186 and it'll be 136. And you take the odds.
Senator,
and tell me the amount I'm going to make.
Senator, I would be glad, but the unfortunate issue is if I were to take your bet, I would be forecasting, and they won't let me do that around here.
Well, yeah. But you're testifying, and you got to tell us. And you don't tell us. I mean, like asset sales. I know you don't like asset sales. When we can't make the house payments, you don't sell off the garage, and then next year sell off the kitchen. I mean, you know better than that, and I've heard you testify previously that if you're going to come up here and psychoanalyze what the Congress did in this pressure, sure, we've done some good. Graham Rudman Hollings brought the pressure up until December, and then it was finessed. We're just about throwing it out of the window now, and we're going to be increasing the deficit. And when it comes to taxes, Dr. Greenspan, what is our tax burden in this country? Comparatively speaking, let's say with West Germany or Japan, our competitors?
It's relatively
less. Or lower?
It's relatively lower than exists in Europe.
Yeah, well, in Europe, for example, rather than just nibbling around for $15 billion on a 15-cent gasoline tax, I'm looking for a good $60 billion. A 5% value-added tax. I need about $30 billion to get the government started again, and $30 billion on the deficit and debt. You know that, and I know that. That's the real problem. You've got the president come out here more for space, more for homeless, 100 million shy on the Coast Guard. We need daycare from coast to coast. We've got all of these needs backed up in the line in law enforcement, drug enforcement, and with those needs, and well as the need, we're not going to be cutting down the size of government. You are never going to get a better government cutter than Ronald Wilson Reagan, and after 8 years of him, it's been a standoff. We need $1 trillion government, and we're only going to collect $800 billion. And you ought to be telling us we can't continue that.
Well, I thought I was, Senator.
No, the best you could, you danced around it and came up with 15 cents on a gallon of gas. And that there is just a pitiful presentation for the head of the Federal Reserve and a man of talent and ability that you have. You can't be tippy-toeing.
The best I've ever seen out of any chairman of the Fed.
Yeah, you got the 15 cents. You finally mentioned the word tax. But for heaven's sake, let's lay it on the line so we'll know the job to be done.
Senator, I've been appearing before this committee for a number of years. I am fully cognizant with the fact that every member of this committee knows the full detail of where all the potential cuts are. I cannot conceive of a Federal Reserve chairman coming up here and creating any new list of means by which the deficit can be closed.
Other than taxes, we haven't had any category. We've got a free ride, you know it.
Yeah, I must say this is an extraordinary experience for me to be sitting here and essentially being positioned where I'm soft on the budget deficit. I must admit, it is a real remarkable difference.
Well, that's right, and you ought to realize it. If you were advising me as governor, and you'd say, Governor Hollings, you better hurry up and pay your bill, you're going to lose your credit rating. That's the first thing Alan Greenspan would tell me.
Mm-hmm.
But for the President of the United States, you dance all around, fine a 15-cent gasoline tax, and say, watch this asset sales, and make the categorical statement, we got pressure on the deficit, and the summit agreement reduces the deficit when we know that's totally false.
Well, no, I don't quite agree with you on that specific point. I do agree with you pretty much, as you know, over the years, Senator, I have with your general approach to the deficit. There was benefit from that summit agreement, not as much as I would like, in my judgment, not as much as virtually anybody on that committee would like.
It gets us all reelected in November, that's all.
Well, yeah, all I can say to you is that as I understand what is in the process of occurring is a growing commitment on the part of the Congress to resolving this budget deficit issue one way or the other. I must say to you, I take comfort from listening to the discussions that have been going on in the last several years on the issue of the desired direction of the deficit, and the impression I get is that no one is willing to throw in the sponge, and there's just continuous pressure. And all I can say to you, I know of no conceivable reduction in the budget deficit that can occur in the short run that could do anything but good for the economy. So all I can say to you is I wish you well, and I don't think you need me to tell you how to do it.
Thank you. Senator Grassley.
Thank you. Chairman Greenspan, I want to start where Senator Sims left off with his questioning to you about the prospects of a recession, and you answered short-term. My question's a little bit more long-term in light of the fact that we're in the middle, or we're in a period of what we're told by the administration, the longest peacetime recovery that this country's ever seen. When are things going to change? Because we know that can't go on forever. I ask my question to you in light of your position being fairly insulated from politics, at least not responsive to politics, and coming maybe from a person like you, friendly advice to what might be down the road, and so we can anticipate it and make changes so it may not be quite as drastic as we know sometimes happens in this country with a long period of recovery.
Senator, I would answer that in two parts. First, there is nothing that I know that suggests that we have cured the business cycle. There is another recession out there. There's more than one. The question basically is when. And in that regard, it's instructive when one examines the length of economic recoveries, and this is statistically the longest in peacetime history. What you find is that how long the recovery has been going doesn't help you very much on predicting the next downturn. As I said in an earlier hearing, we don't have any significant geriatric characteristics of this recovery. In other words, it doesn't look like an age recovery if you look at the relationships between the levels of inventories, of lead times on the deliveries of materials, on commodity prices. In other words, we don't have right now a lot of those symptoms which signal the tail end of a recovery. They will occur, and we will have a recession at that point. What I'm saying, however, is you can't really find many of the early signals of that at this point.
Let me go on to another subject then. And I'm not sure I'm totally satisfied, but I want to cover another item. Our government, our political leadership has been very aggressive in the last year to 2 years of bringing down the value of the dollar in relationship to the major currencies. Do you think that ought to be extended? In other words, would you be advising that same vigorous effort towards reduction of the value of the dollar in relationship to lesser currencies in the world where we still have a very unfavorable balance of trade with some of those countries, Korea, Taiwan, Singapore, Pacific Rim countries, to name some where the value of the dollar hasn't changed any recently?
Well, first of all, I wouldn't say it has been the policy, with the exception of the period immediately following the Plaza Agreement, to drive the dollar down in a conscious manner. But on the issue of the lesser currencies, as you call them, I think there's already pressures in the marketplace for exchange rates of those countries to begin to adjust to economic realities, clearly we would be much more desirous of seeing those adjustments take place, and I think that, as best I can judge, they are in the process of doing so.
But you're saying that's being done through the marketplace and not political, as there was a political decision with the conference you referred to?
Well, I think that we've communicated appropriately to the various parties involved that we think that they were basically fighting market forces, and if they just allow market forces to function, you would get adjustment. I mean, for example, the extraordinary accumulation of reserves by Taiwan, my recollection, it's in excess of $75 billion, suggests to anyone who is looking at the situation that the balance is inappropriate and that presumably the currency is incorrectly calibrated.
Mr. Chairman?
Senator Fowler?
Thank you, Mr. Chairman. Dr. Greenspan explained something to me that, in strictly layman's terms, I must be missing something. It seems to me if you take all of the, talking about in the trade area for a moment, exports and imports, if you look at all of the industrialized world and add up the exports on one side and the imports on the other side, they ought to equal, shouldn't they?
Oh.
And what I don't understand is that every time I look at, try to bring in all the figures, which are a little hard to get, especially on a quarterly basis, all of our allies, all of our major trading partners, EEC, Canada, Japanese, the exports usually run 60, 80, 100 billion dollars over the imports. Now, I can understand why it would be in the domestic interest of a sovereign nation, the domestic political interest of a sovereign nation, to overestimate their exports. But I'm wondering whether or not you find the same phenomena, that the books don't balance, and whether or not you feel like we can trust the figures.
Well, Senator, on the merchandise accounts,
we had a specific problem with Canada, as you know. We had to go back in.
That's correct. And
we found out that the Canadians were basically right.
Yes, and I think that...
now, is that also happening in Japan and the EC?
Not to our knowledge. There's a few technical problems in the way one evaluates this. Sometimes you get reporting in which included in imports is freight and insurance costs. And as a consequence, sometimes when you add up all of the exports, they won't equal the imports, because the imports include not only the value of the exports, but for individual countries, all freight and insurance costs as well.
But that would be minimal, would it not?
It is. It's not a big thing.
It
However,
wouldn't be 50, 70, 80 billion dollars off.
No, but it isn't. If you adjust the imports to the same export values, meaning FOB, port of embarkation, then for the world as a whole, there does not seem to be a significant imbalance. There are a number of countries for whom the data are so poor that numbers for imports into industrial countries are used as proxies for the exports of countries for whom the data are really quite poor. But if you add up the industrialized countries' imports and exports, the developing countries, including the OPEC countries, I think you will find that for the trade balance, it comes out reasonably close. The world statistical discrepancy is quite small. However, if we are talking about the broader measure, the current account balances, which include mainly import and exports of services as well as the trade accounts, then we do have a chronic world deficit, so to speak, in the statistics, which of course can't exist. In short, we seem to be underestimating some of the service, presumably investment income accounts of a number of countries. But as best I can judge, the trade data, when properly evaluated, seem to come out okay.
Well, I'd like to pursue this with you at another time. It's becoming very difficult to understand, to figure out what you can believe. I think it's very hard to frame the debate anymore after 10 years in this business, because when you get into whether it's trade or even our domestic accounts, everybody does it differently. I'm not talking about political parties and presidents for a minute. As you know, if you're in France or England, and they had the situation that we had in this country, where you've got 38 or 39 states in surplus, those surpluses, were they in most of our trading partners' countries, would be counted in the national accounting system. I'm not suggesting this to the President and his administration, because we may see that next week as a way to further lessen our budget deficit. But as you know, there are many countries where there would be an extra 100 billion or whatever it is there as an offset to our deficits if we use the accounting system that they have. On the other hand, you also, on this export-import, I appreciate your answer, and I want to think about some other things and pursue it at another time. But I think if you'll go back and look, the difference between the world exports and the world imports are 100 to 160 billion dollars off on the export side, which is not possible. And it's certainly not accountable just by insurance and freight charges and things like that. But anyway, I wish you would look at that, and if you have some bright people who've got some papers on this that show me how those two can reconcile, I'd very much like to take a look at it.
Why don't I send you a note on that, Senator?
I'd be very appreciative. Mr. Chairman, if I have, has Pete not had his?
I haven't, neither has he.
Well, I relinquish then. Thank you very much.
Mr. Chairman, thank you, Mr. Chairman. Let me see if I can ask you what primary deficit means. You gave us a very simple definition: deficit minus interest payments. Now, maybe I'm doing something wrong, but 1987, under that definition, the interest payments equal 139 billion. The deficit equals 150 billion. Do the subtraction, and the primary deficit's 11 billion.
Well, what you have to do in that calculation, Senator, is to take the interest payments after tax receipts. In other words, to the extent that the interest is income which is taxable and hence part of the revenue side of the budget, then you have to reduce it, I don't know what the actual number is, maybe by 20 billion or thereabouts, but that's correct. If you take the 11 and add back in a sense, that the tax effect on the interest paid, you get a number which is clearly 30 to 50 billion, something in that area. I would
So your definition of primary deficit for 1987 is somewhere within the 30 to 50 billion range instead of the 11, which I would do by simple arithmetic.
Well, actually, we do have a number. I just don't have it available with me, and I will submit that number for the record.
I would appreciate it. The reason I was so impressed with 11 doing the arithmetic is that I was going to remind you that we would wipe it all out without doing anything else if you reduced interest rates 1%. And it does prove my point that, you know, we keep going round and round with interest rates feeding the deficit and the deficit feeding the interest rates. If that's the primary and singular measure that we use. Now, let me ask you I want to focus quickly on two issues. Some senators now have circulated, not this senator, and to my knowledge no one on this committee, but some have circulated a flow chart through the year 2020 of the Social Security Trust Fund, indicating its accumulation of reserves under various economic scenarios. And even if one takes what is called the most pessimistic, I don't have it in front of me, but I'm going to give you some just approximations. 7 or 8 years, 9 years out from now, there is a huge accumulation. You know why that was built in. You were on the commission. In fact, you were one of those most responsible for doing that. Let's assume that, for purposes of this discussion, that at some point in the recent future, not too far out, we get $1 trillion reserve in the Social Security Fund. Now, macroeconomic-wise, and Chairman of the Federal Reserve, how do you perceive that huge fund versus our annual deficit, and how do you perceive it in terms of is it a savings account?
No, sir.
All right. Well, how do you perceive it? I guess we ought to say for the record, you can only use it under current law for investment in the debt of the federal government.
That is correct. And as a consequence, it is a bookkeeping adjustment. It is not something which anyone who is involved in evaluating the net demands for credit by the federal government pays very much attention to, because it's an intra-governmental transfer. As far as evaluating the impact of the federal deficit on the financial system and on the economy as a whole, so long as the holdings of the Social Security Trust Fund are in U.S. Treasury obligations, then it's a wash. And that the unified budget is the only one which we pay particular attention to, because it's that which creates the net demand for credit, the net effect of the federal deficit, and I would be concerned if one would perceive of that as, in some sense, some large savings, because remember, the obverse of that Social Security deficit is invariably going to be, or rather Social Security surplus, is going to be a deficit in the accounts of the federal government excluding the Social Security system. If it were not the case, then we would be running a very significant surplus on the unified budget concept.
Well, I guess I just want to ask you this very practical question. I think it will apply ultimately here, but it surely will apply as these commissioners that are appointed for the Economic Commission. Just very practically, if in 6 years the reserves under a unified budget wipe out the deficit for that year and create a surplus for that year, how do you look at that?
You mean on a unified
On a unified basis. You say the unified basis is what we ought to continue to use.
Yes, sir.
So you keep Social Security on that unified. It has a huge surplus as compared with the annual deficit. So in that year, you might be on plus side in terms of the annual operations of the government. Is there no longer a deficit in that year then?
For the consolidated U.S. Treasury accounts, there is no deficit.
Is that considering how long it will take before that fund is depleted, is that a salutary situation?
I would say that obtaining a surplus on the unified budget concept, irrespective of how it is achieved, is a desirable end in the long term, because we have a shortfall of domestic private savings in this economy, which we do not seem to be able to reverse.
Now, let me move to how you set monetary policy. Again, I believe that you have told us about the deficit here, and we all know about it. We'd like to know a little bit about monetary policy. I'm somewhat concerned, to tell you the truth. I think real interest rates are still too high. I'm very fearful that there are people around urging that any reduction, substantial reduction in those, will be politically motivated. I want to make sure that you hear from some who don't want the reverse to happen, that they're kept too high because of the fear that there will be political accusations. However, I think your predecessor, after a couple years of struggle, finally got around to using some very objective measurements of money supply upon which the Federal Reserve predicated its activities vis-a-vis interest rates, discount, etc. I now hear, although no one is privy to your private meetings, that members of your board other than you are suggesting that the Fed is watching a number of other indicators. And if these are not actually targets, these indicators, it seemed to me, are sort of a monitoring device. I've heard it said commodity prices, the dollar, the so-called yield curve. Now, I frankly believe that that puts the Commission into a position where they may not be motivated by clear-cut targets, but rather by judgments. And frankly, I think that's a very dangerous path. Could I get your observations on that? And I understand you are merely a member, the chairman, and you have a difficult time. You have to have majorities. But I'm telling you my own honest concern, and that is not, I really don't believe there is any justification for real interest rates being higher today than 2 years ago, based upon the simple premise of the deficit, because the deficit's coming down, not up, and substantially, in spite of the laments. 1.5% of GNP reduction in the deficit is pretty good. If you do that every 3 years, you'll be out of deficit in about another 4.5, 5 years, which is not all that bad.
Well, Senator, first let me say I'm not certain that I agree that the long-term real interest rate is higher than it was 2 years ago. The reason I say that is that what we are dealing with is a judgment about what the market's long-term inflation expectation is over the life, the full maturity of the debt instrument to which it's applied.
Mr. Greenspan, I'm going to miss the vote if I don't go.
Sure.
I'll try to pick it up.
The chairman will be back in 1 minute, and we'll continue at that point.